once silver gets going, they always tend to find an excuse or a reason. Now I know why. But meanwhile, you're $55 and just blew out the two highs of the last 50 years before those headlines start to hit the public. And that's kind of what I expect, is that once the silver engages in its next leg, and I think we're about to, that it will be dramatic. And those two peaks at 50, there were, brief moments in time, 1975, 80, and in 2011. So it really wasn't a price level that sustained it all. It was for literally a few days. But those old highs will come out. And I think at that point, you're going to see silver do something like what we looked at on the XAU versus gold chart. Silver's equally depressed versus gold. And if you look at the spread of silver versus gold going back 50 years, you'll see that 20 of those 50 years.
Once silver begins its next major rally, it will likely move sharply before mainstream narratives catch up. Historically, silver has briefly surged to $50 per ounce in both 1980 and 2011, but those levels were not sustained. This time, as silver breaks past those previous highs, it could experience a dramatic upward move, similar to its historical performance relative to gold. Silver may be poised for a significant breakout shortly, given its current undervaluation. Michael Oliver is a renowned financial analyst and Momentum Structural Analysis (MSA) founder. Highlights that gold has remained bullish since February 2016, with momentum consistently supporting higher prices. Despite periods of consolidation between 2020 and early 2024, where gold repeatedly tested and retreated from the $2,000 level, a decisive breakout occurred in March 2024. Silver and gold miners, which had lagged, also began re-engaging, signaling a broader acceleration phase. Though gold and silver prices continue to experience pullbacks, the overall trend remains upward, gradually shaking out weak hands and keeping mainstream enthusiasm low. Michael exposes that despite the stock market being the focal point of financial media, gold has quietly outperformed equities over the past year, delivering better returns than the S&P 500. Since December 2015, gold's performance has nearly matched that of the stock market, while gold miners, an often overlooked sector, have outpaced broader equities. As market uncertainty rises, asset managers seeking stability and value may increasingly turn to gold and mining stocks, which remain undervalued relative to their potential. As we present clips from the video, please like this video, subscribe to the channel, and turn on the notifications bell to be instantly notified every time we upload a video.
We've been bullish on gold since February 2016, based on annual momentum, and frankly, nothing on annual momentum has altered that bullish view since then. You say, well, that's a long time. Well, look at the last bull market. Started from lows in the year 2000, 2001, and lasted till 2011, okay? And that wasn't even under the conditions we're facing, talking macroeconomic, global debt problems, etc. So we're bullish on gold and silver ongoing. We've never changed. All the nonsense on the way up is just arm wrestling. But we did go through a period from mid-2020 through early 2024 where silver and the miners staircased down and gold went sideways. Go up over 2,000, got hit. Go over 2,000, got hit. Go over 2,000, got hit. Go over 2,000, got hit. Okay. Persistence is what that's called. But that congestion zone, by our metrics, broke out in March of 2024. Now, in other words, we had enough long-term metrics that re-engaged after being asleep for a while. Quarterly momentum, for example. Not annual. Annual is still positive. So gold then was just above 2,000. Okay, well, this time, it was the fourth time. How do you know it wasn't going to fail? Because momentum said we're not going to fail this time. Okay, it was going to engage. Silver was 25 to 26 zone. Still well below its $30 high it saw in 2020. But momentum said, no, we're coming out of here. Gold miners, GDX, for example, was 31.5 is our trigger level. Oh, it traded up to 41 the other day. Okay. So but we still have this arm wrestling process, where you make a couple $100 in gold. Next thing you know, you drop back 100. I don't know, or silver goes up $3 or $4 and drops back 2 or 3, and then goes again, but it's an arduous process and it keeps shaking people out. It keeps people skeptical. It keeps the enthusiasm low. As far as I'm concerned, that's great. Keep it low, okay? We want to compress it. Meanwhile, the enthusiasm's over there in the stock market. But if you do objective measuring, let's say you're an asset manager, and you're a little bit nervous about the stock market. First off, it hadn't gained much ground since its July high. I think the S&P's up about 3% or something. But if you go back and look, and let's say you're the head of the fund, and you ask your trading guy in the back room, technician, say, give me some ideas of other places to be that might be safe, that might be lower risk, might be cheap, And he says, well, boss, gold miners, we'll show that chart in a minute, but gold miners are cheap and starting to firm up. Since the close of January 24 to the close of January 25, so a 12 full month period, gold beat the pants off the stock market. What? You wouldn't believe that if you listen to Fox Business News because, Trump got elected, or if you listen to CNBC. The stock market is the fever. Nobody seems to be noticing that gold has beat the stock market over the last year. And in fact, since the last 9 years, has almost matched the stock market. When gold was back in December 2015, for example, was $1,050. You go back and check where the S&P was then and do the percent gain, and you'll find S&P's barely beating gold. And when you measure it against the gold miners, a tiny little subsector of the stock market nobody cares about, it's beating the stock market.
Michael discusses with Dunagun Kaiser that gold miners have historically traded at a significant percentage of gold's value, with past ranges between 17% and 35%. However, from 2008 to 2015, the relative performance of miners collapsed, hitting a low of around 5% in late 2015. Since then, miners have been steadily recovering, with the X index up 262% from its 2015 low, outperforming gold's 171% gain over the same period. Despite this, many still perceive miners as underperforming because they have not yet reclaimed their 2020 highs, unlike gold and silver. Technically, Michael explains gold and silver miners appear poised for a significant breakout. A long-term downtrend line dating back to the 1990s has been tested multiple times and is now being nudged higher, signaling a potential shift. If the miners' relative performance moves beyond this resistance, it could mark the beginning of a strong rally. Given their historical valuation ranges and current positioning, gold and silver miners may be the best performing sector in the coming year. Now let's dive into the interview.
And you go back to the mid-1980s on that spread, and you could see that if you divide XAU into gold price at that time, XAU was trading about 30%, 25% of the lows were about 17.5% of the price of gold, and its highs were up at 30+%. In other words, it was trading about a third of the value of an ounce of gold. Okay? But then in 2008 through 2015, the spread collapsed, where the relative performance of the miners dropped. It actually started dropping before the gold market even peaked in 2011. Net price peak, I'm talking. And they collapsed that spread down to the late 2015 low, where the XAU index briefly got below 5%, dividing it into gold again, of the price of gold. Very low level, obviously, when you look back and see the prior decades have been up there in the 20, 25, 35% level. So something happened. Well, they crushed the miners. Okay, fine. Means they're cheap. Okay. But if you actually measure that spread reading, which was below 4%, back in late 2015, the low monthly close, was also the low monthly close on the spread. Not just price of gold and the miners and silver, but actually of the relative performance of the miners. Since then, that spread has risen and stayed in a range that's been above that low. Now, actually, I just checked before we got together here. XAU index right now is trading at 262% gain since its low close in December 2015. Gold is trading 171% above its low close in 2017. 262%, 170. I'm talking net price now. XAU is up that much. It's up more than gold. And yet everybody thinks the miners are a dog. Well, one of the reasons is that we made a high in 2020 in that surge, which took gold during the post-COVID event, and blew gold up to 2,000, over 2,000. And since then, price of gold has exceeded that high. Price of silver exceeded that high. It was $30 back then, or actually a high monthly close, about 29. But XAU and GDX, for example, are still below that price high. And so people think, well, they're underperforming. Actually, they're not. They're off that high, yes, off the best levels that they've seen, but they're still, over the last 9 years, are beating gold. Now, the issue is, and this is what we think is likely to be the best performing place to be this year, is the gold and silver miners. XAU being a representative of GDX being the trading vehicle. Okay. That spread, if you look at it carefully, there is a 3-point downtrend line going back to 1990s, I think it is. Let's see. Early mid-1990s, there was a peak up there at 35% plus. You could draw a downtrend line, and you can see over the last year or two, since that 2020 surge where we bumped that line on the spread, we've been backing off on the spread, still above where it was in 2015, but hugging that line. Well, recent action is nudged out above that trend line. Okay, that's a wake-up call. There's also a range here you can see on the spread chart. Again, it's price versus price, so in effect, this is a price chart. You can see the upper end of that range, and GDX has a similar spread chart with a similar range, just at a different level. And we think, based on technical reasons, that you're likely now to see that spread move not just above that trend line, but take out the top of that base. In which case, it's still dirt cheap relative to gold. Look back, 30, 40 years here.
As gold and silver continue their long-term bullish trends, the potential for a breakout in silver and mining stocks remains strong. With historical patterns, technical indicators, and rising market uncertainty all aligning, precious metals and miners may soon attract greater investor attention. If momentum sustains, these assets could significantly outperform mainstream equities in the coming years. How might rising geopolitical tensions and central bank policies further impact gold and silver prices? What key technical levels should investors watch for confirmation of a sustained breakout in silver and gold miners? Share your thoughts on Michael's suggestions in the comment section below. Also, please like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.